In this lecture, we focus on farm records and financial management. We will begin by explaining why farm records are essential and how they are used in management. Then we will compare cash and accrual accounting systems and explain when each is appropriate. You will learn key financial terms such as asset, liabilities, owner equity, accounts payable, and accounts receivable. We will also construct and interpret a balance sheet and use it to analyze the farm's financial position through liquidity and solvency ratios. Finally, we will discuss how different asset valuation methods apply to various farm resources. Farm records serve multiple critical purposes. First, they help measure profit and assess the overall financial condition of the business. Second, records support business analysis by identifying strengths and weaknesses. They are also essential for external reporting, providing reliable information to lenders, partners, and government agencies. Records allow managers to track the profitability of individual enterprises, such as specific crops or livestock operations. In addition, they support investment analysis and ensure accurate income tax reporting. Without good records, effective farm management is not possible. Farm records track three main types of business activities. Production activities include revenues and expenses related to growing crops and raising livestock. Investment activities involve long-lived assets such as land, buildings, machinery, and breeding livestock, including their purchase, depreciation, and sale. Financing activities include borrowing money and servicing debt, such as loans, operating credit, and accounts payable. It is important to note that some items overlap. For example, interest is a financing activity but is treated as a production expense for profitability analysis. Setting up an accounting system requires several key decisions. Managers must choose the accounting period, either a calendar year or a fiscal year. They must also select the accounting method, cash or accrual. Another choice is whether to use single entry or double entry accounting systems in the farm. Finally, managers decide on the scope of analysis, basic or complete, and whether records will be kept for whole farm or individual enterprises. These choices shape how useful the accounting systems will be for both management and reporting. The accounting period defines the time frame for measuring financial performance. A calendar year running from January 1st to December 31 is the most common choice and works well when production cycles and in winter. A fiscal year can be any 12-month period and is useful for crops harvested in winter, such as citrus or winter wheat. The general rule is that the accounting period should end when business activity is slow, making it easier to close the books accurately. The chart of account is the organizational backbone of an accounting system. It categorizes all financial transactions into asset, liabilities, equity, revenues, and expenses. A well-designed chart of accounts ensures consistency, simplifies record keeping, and allows meaningful financial analysis over time. Accounting systems differ in both entry method and scope. Single entry systems record only one side of transactions, usually cash, and are common in basic cash accounting. Double entry systems record equal and offsetting entries for every transactions, ensuring that asset equal liabilities plus owner equity. Double entry systems are more accurate and allow balance sheets to be prepared at any time. In terms of scope, records may summarize the entire farm or be divided into enterprise level accounts. Whole farm accounting summarizes total profits for the entire operation. It is useful for comparing performance across years or against other farms. Enterprise accounting, on the other hand, breaks the business into profit centers. This allows managers to identify which crops or livestock enterprises are profitable and which may need to be improved or discontinued. Basic accounting systems rely on manual cash records or simple financial software. Complex systems are computerized and integrate both cash accounting for taxes and accrual accounting for management. These systems can track inventory, calculate depreciation, manage payroll, and analyze production quantities. As farms grow in size and complexity, complex systems become increasingly valuable. Specialized agricultural software is designed to handle unique farm needs. These include tracking, breeding, livestock, government payments, and operating under both cash and accrual systems. Many platforms are scalable, allowing farms to start with basic features and add modules like inventory or payroll as the business expands. Cash accounting records transactions only when cash is received or paid. Revenue is recorded when cash comes in, regardless of when the product was produced. Expenses are recorded when they are paid, not when inputs are actually used. The main exception is depreciation, which is a non-cash expense but still recorded. Cash accounting is simple and flexible for tax planning, but it often distorts profit by failing to match revenue with the expenses that generated it. Accrual accounting records revenue and expenses when they are earned or incurred, not when cash changes hands. All products produced during the year are recorded as revenue even if they are stored or sold on credit. Expenses are matched to the production year in which they contribute to revenue. Accrual systems provide a much more accurate measure of profit and are superior for financial analysis, though they require more time and accounting knowledge. A complete accounting system can generate up to 12 different financial reports. These reports support management, tax preparation, credit analysis, and long-term planning. Among these reports, the balance sheet plays a central role in evaluating financial position. The balance sheet is a snapshot of the farm's financial position at a specific point in time. It lists everything the business owns, its assets, and everything it owes, its liabilities. The difference between asset and liabilities is owner equity, also known as net worth. Assets are divided into current and non-current categories. Current assets are expected to be sold or used within 1 year, while non-current assets are long-term production resources. Liabilities are also classified as current and non-current based on when they are due. Owner equity is calculated as total assets minus total liabilities, reflecting the owner's financial stake in the business. Assets can be valued using different methods depending on their nature. Market value is best for liquid assets like grain and feeder livestock. Cost value is commonly used for land, feed, and supplies. The lower of cost or market method avoids overvaluation and helps manage inflation risk. Farm production cost is used for immature crops. Cost less depreciation or book value applies to machinery, building, and purchase breeding livestock. Cost basis balance sheets value asset using cost-based methods. Grain and market livestock are often still valued at market price as exceptions. Raised breeding livestock may be valued using full cost absorption or a base value method. Cost-basis analyses are conservative and ensure that changes in equity reflect earned income rather than inflation. Market basis balance sheets value all assets at current market prices minus selling costs. This approach typically shows higher owner equity due to inflation, especially for land. Market basis statements provide a realistic picture of current financial condition and collateral value, making them especially useful for loan applications. The key difference between cost basis and market basis balance sheets lies in how equity changes are treated. Cost basis statements focus on operating performance, while market basis statements reflect changes in asset values. Both are useful, but for different purposes, and managers should understand when to use each. Owner equity comes from three main sources. First, personal capital or property contributed by the owner. Second, business profits that are retained rather than withdrawn. Third, changes in equity due to market value fluctuations, which appear only on market basis balance sheets. Balance sheet analysis focus on liquidity and solvency. Liquidity measures the ability to meet short-term obligations. Solvency evaluates the long-term ability of the business to cover all debts if assets were liquidated. Together, these measures provide insight into financial risk and stability. In summary, farm records are the foundation of effective management. Managers must choose between cash and actuarial accounting systems, balancing simplicity with accuracy. This balance sheet provides a financial snapshot governed by the equation asset equal liabilities plus owner equity. Asset valuation methods influence how equity is measured and interpreted. Finally, liquidity and solvency analyses help assess both short-term resilience and long-term financial health.